Tonight, we're going to be discussing price action, and one of the major strategies we're going to be looking at, and one of the most important price action strategies, is the inside bar trading strategy. Now, what is an inside bar? As the name implies, an inside bar forms inside of a larger candle that we call the mother candle. Yep, that's the name of it, the mother candle. It's a parent that forms after a large move in the market and represents a period of consolidation. This is why trading this pattern can be so profitable. You are essentially buying or selling a breakout or a continuation of the preceding trend. So what we have is a large candle when it appears that's called the mother candle. We have a second candle, which is considered the inside bar candle, which is smaller than the previous candle, and is usually in the opposite color. Now, I'm going to show you this in great detail, so don't freak out. And it's very easy to find. Notice how the second candle in the image is completely engulfed or contained by the previous candle. Now, don't mix these up with bullish and bearish engulfing candle patterns. These are called inside bars. So in this case, the bearish candle or the mother candle represents the broader downtrend, while the bullish candle, the inside one, which is the most common one, represents a consolidation after the large decline. Now keep in mind that there can be more than one candlestick that forms, and it is also fully engulfed by the candlestick to the left. At the minimum, it is a 2-bar pattern. So here you can see 3 different types of what we call inside bar patterns. Now think of it as a mother bar and a baby bar. The mother bar is always to the left. The baby bar is always to the right. The baby bar is always smaller than the mother bar and should be of the opposite color. Okay. Not difficult. Mother bar, baby bar. Or inside bar if you don't want to sound not professional. But they are called mother bars. That's how they're known. So what does the inside bar indicate? In our graphic, we have a strong bullish candlestick. Okay, that's the mother bar. Okay. Strong bullish. The candlestick forms on the left. Then the candlestick forms inside, opposite color, a bearish candle that's smaller than the previous mother bar. So what's an inside candlestick? Well, let's step back for a second and let's be precise. Because details do matter here. Because we're not just arbitrarily going out there and looking for every time we see a big candle and a little candle making a trade. So let's assume our green mother candle is the largest one in the recent price action on the chart. The market has moved with the momentum, and the next candlestick in the chart can't take out the previous bar's high and low. We can say that volatility has dried up at this point, or at least is not as strong as the previous move. Now you have to remember the mother bar, if it's a green bar or a bearish bar, a bullish bar, has to be taking place in an uptrend. If it's a bullish bar, a bearish bar, black bar, it would have taken a red bar would have taken place in a bearish trend. So this is one of the immediate disqualifications. So you can't just look for a big candle and a little candle. Big candle, mother candle must appear in the trend it currently is and in the color of that current trend movement. So here I put it together in a little bit of a graphic presentation for you. And let's take a watch at this, and then we can come back, but I've tried to show it to you actually in a creative format.
So as most of us know, a basic candlestick is made up of a high and a low, which indicates the complete range on the day, as well as the open and the close, which can tell us a bit about momentum, as well as who is in control of the day, whether it was the bulls or the bears. So the inside bars do not necessarily open and the close. And what this shows us is that a range is tightening. We have a lower high and a higher low forming. So an inside bar is when the range of a candlestick fits completely within the range of the previous candlestick. It's what we refer to as the candlestick with the larger range. And then the inside bar comes after it, and it forms a tightening range. If the inside bar were to come on the left side of the candlestick, that does not count, because we want to show through time forming, and it's usually accompanied by a decline in volume, and it shows us that an equilibrium is being reached. Now, why does the high and the low matter? Because of that equilibrium. It's a tightening range. And if you were to zoom in on any time, so if you were on the hourly time frame and seeing inside bars, if you zoomed into the 5-minute time frame, you would see higher lows and lower highs with a tightening range. And that leads to a point, a flex point, where we see the range just shrink, shrink, shrink. And then we have our break. And on that break is when we see a break and a spike in volatility with momentum as well. And it's significant because it gives traders a heads up what to watch for. And the break is with a spike in volume. Oftentimes I recognize that a break is about to occur, not only because the price level is so very clear, but it's because the volume spike is accompanying it. So what we're looking at for a break of the inside bar, let's say these two candlesticks have completely formed. We have the range of the break, the high of the inside bar, it's a bull break. And if we break the low of the inside bar, it is a bear break. So it is the price level, the high and the low that we are looking at to indicate the trade. Now, how do inside bars work? They develop in strong market conditions. You see the put down and trade sideways while we consolidate. Here's an example right here where we have a large range candlestick on a breakout. Then we see a smaller range and a tighter range, two inside bars in a row before we finally get a bull break and continuation. So in this example, the bullish signal for entering the trade would have been the break on the second inside bar. As soon as the high of that inside bar, the inside bar pattern, by definition, is showing us consolidation is occurring. And obviously consolidation most often occurs after a big move to the upside or a big move to the downside. So you can look at these and look at the macro or micro version. So the macro is the zoomed out version with just a few candlesticks. A micro version where we have, let's say these are half an hour candlesticks, and it shows us, rather than just a few candlesticks showing us highs and lows, this is showing us in between the highs and the lows tightening range. It often occurs with triangle patterns or pennant patterns, but you don't even need to be aware of these trend lines because it's the high and the low that we are concerned with. And these trend lines are just a bit of a guide to show us when the flex point is coming as to when the break is most likely to occur, because we are running out of space and it's getting tight to the point where we know it's significant. Because it tells us, pay attention, things are tightening up, we're going to see a volume spike and a breakout from this tight pattern that we are currently in, and it's going to indicate the direction that momentum is headed. In this first example of inside bars, we're going to be looking at Apple on the daily time frame, and this was coming after it is the preceding action being volatile and a strong move to the upside with big volume accompanying it. After that plays out, we see the volume drop off over the next 2 days and the range tightens. So the following day was an inside bar. You can see the high and the low completely fitting within the high and the low of the previous day, which is the mother bar. So we have our mother bar or inside bar. Next day was a day in a row. Volume dropped off again just barely. And then on the third day of this pattern, actually the fourth day, we see a bull break over the high of the previous day. And it comes with an increase in volume. And then from there, it showed us bull momentum and the bulls continue to the upside. So we see a very clear pattern. And this is a very simple pattern. Once you get it down, you can pick out these inside bars. If we were to look at it on the hourly time frame, here is the run up on earnings, and then this is when the consolidation begins. It's a tightening range. We're trading sideways. Look at the volume. Each period of volume is lower, 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 and then it spikes with the bull break here. So our low on the consolidation, our lower high then formed, our higher low, lower high, higher low, there's our break. So a way that I visually mark these out a bit better is I put some lines where the candlesticks their lows, and then we just patiently wait for that break. And getting a little cluttered in there, so I would remove that one because this is the top of the inside bar, the most recent one. And then there's our bull break on the candlestick. As soon as we break above the previous high, momentum go. It's up to the upside. So on the daily time frame, the high of this second inside bar was at 129.19. As soon as we break 129.19, that is the bull signal for entering a trade. So as most of us know.
So as you can see, we started with a longer period of time frame to see the bull break or to see the breakout or the inside bar candles. And then we moved it to a smaller time frame to define our trading. Now, what is an inside candlestick? This happens as the move is digested. Remember, we have traders using all different time frames. So we could have traders taking profits on their buys from a lower time frame, momentum traders bailing as there was no follow through, contrarian traders who are trading against a trend. You have all kinds of things going on at the same time you're getting this break. So there are more reasons, of course, but you couldn't just cover all the scenarios. So just the higher level ones. Understand that when you see this type of chart pattern, whether Forex trading or trading stocks, you are looking at the inside bar trading type of setup that depends on momentum showing up to carry price through the high low of the previous candlestick. So one of the most key pieces of information we have is volume. So let's go over to another chart I've got set up here for us. Okay, and it's going to pop up on the screen saying, this is a current live chart. This is the pound US dollar. And you can see our projection here in the red. We did get the inside bar here. Okay. We have projected with our support and resistance level here. We've started to draw out the highs and lows. Now the red over here is just a prediction for the future. It's not happened yet. Okay. But what we would do is we would look for an entry level here. We would set our target points down here. And right now we are just moving into this red area. Okay, so we're looking for something to trigger. We've got our trade set up, but we still need a trigger to tell us that we can absolutely make that trade. So we can also add volume onto our indicators. Because this spike in volume combined with the inside bar candles gives you the whole story. You would enter your trade here. You would take your target to the first or the second level, put your stop loss up here, and you would have looked for the entry up here, but we had no entry clue, so we're entering here. Hold on 1 second. Okay. Now, the candlesticks look strong because one or only two candlesticks are shown. We can only say with confidence, strong bullish if the green candle is larger than most of the price action that would have formed to the left of it. But we can only look at the mother bar on the left and then the right-hand side candles. Each candle that forms inside, that stays inside the high and the low of that mother bar is still an ongoing scenario because you could have 3, 4, 5 candles. You're looking for that break out of that original mother candle. So like you can see here on this chart, we have this mother candle, and you're not looking at the body of the candle. You're looking at the high and the low points, and then you're looking for the candles to remain inside that high and that low. So this candle and this candle remain inside that high and low. This candle is finally the candle that broke out. So this was the mother, these were the baby candles. So here's another one where you can see. So the golden rule about trading with inside bars is do not trade an inside bar in isolation. Now, since the inside candle has a lower high and a higher low than the previous candle on the chart, this indicates that the currency pair is consolidating. Why is it consolidating? It's consolidating because the bulls cannot manage to create a higher high, and at the same time, the bears fail to create a lower low. If you're coming off of an uptrend and you get that first mother candle and everything's moving up and making higher highs, because in an uptrend you should be making higher highs and higher lows, and the next candle can't continue that higher highs, but it still hasn't able to make a lower low, it's still making a higher low, that's telling you there's some disturbance in the marketplace. And that's why you get the creation of the mother bar and then the inside bar. So let's talk about the characteristics that matter, because it's easy to say, okay, there's an inside bar, there's a mother bar, we got it made. Okay, here we have this, we got 3 inside bars, we got a spike in volume. You got to understand all the characteristics that we need to put into our decision. If we can agree that there is no edge in simply selling or buying areas where an inside bar shows up, then what type of strategy can we use? We can use any type of trading strategy. It's not an inside bar trading strategy, though. We are not trading the inside bar. We are trading location, structure, market mechanics, and using the inside bar as a trade entry strategy. So this is a vital distinction. Look for inside bars to show up in areas where we can expect some type of price reaction. This will give us a better chance of success. And to highlight that, I'm going to look at a 15-minute chart from above. Okay. Now, look at the inside bars around the support and resistance levels of either side of the trading range. So you can see here, these lines give us the support and resistance areas, and we can see the consolidation as price moves up to that support area. So remember that inside bars show us a lack of volatility as the move is digested. So we're over here at A. We are looking for the relieving of that pressure that builds up in consolidation to get us into a trade at a favorable location on the chart. So let's go step by step. Okay, A, this top was put in after a 1,150 pip run up on price. So we see where we have A, you see that top. That's actually a top of an uptrend. We go to B, price pushes up. So remember, when price moves up, it doesn't go up directly. Price moves and pushes and eases. Push, ease, push, ease, push, ease. So this was a push from a serious uptrend. This was the ease. It doesn't tell us the trend is ending. It's just the ease. We don't know what's happening here yet. So we ease back down and then we push back up. This gives us B. Price pushes above a resistance level, through which is something we'd expect to see at least a few candlesticks later. Our green inside candle forms above and below the tested resistance line. So we can see the resistance line drawn by the swing high from the top of the price as a push from the last push. We now have price moving up to this resistance line, and we have a couple candles through that, or at that resistance or above. Our green candlesticks form above and below the tested resistance line. Given the context, an extended market, a breakout, and no follow through, a short makes sense, because what we saw was we had all 3 of these candlesticks at or slightly above the resistance line, but none of it's making any headway. So given the context, an extended market, because we're coming off a very long uptrend. So we're looking for that uptrend possibly to end. We had no breakout, and no follow through. So at this point, we would be looking to short. We're not doing anything yet, but we would be considering a short because we're looking at that trend having ended. We have to use some other pieces of information. Volume would help us all along the way. Now it's C. So now we had this big candle, but it wasn't a mother candle because we have no inside candles. So we have that big drop. So price has broken with momentum. The support level that formed around B, and the price has pulled back towards what may be potential resistance, which is the low created from these three candles. Price forms a trading range. We get a poke above the range price and recover back inside. So we've gone into consolidation. This is just the movement of price. It's price action. Okay. Now we get a poke up towards the resistance level and a poke down, but we're not making any headway. And we get an inside candlestick. No reason, and it's not to short yet. We have no reason and nothing here within C to give us a short or a long possibility. So there are 5 things that you want to look at when evaluating any inside bar pattern. Think of this as a checklist for trading inside bars. So I'm going to show you one example, and then we're going to go on and talk about it, breaking it down.
On this next example, we're looking at gold on the hourly time frame, and we're going to find an inside bar here. We can see we're in an uptrend of higher lows and higher highs. We're trading sideways and consolidating, and we're looking for a break. And here's an inside bar, so we can low, 44.01 is the high, and the next candlestick on declining volume, it's completely within that range. As soon as the high of this inside candlestick breaks, that is our bull signal. It comes with a little uptick in volume, and then the move is to the upside. As soon as the high of this inside bar breaks at 1243.66, that is our bullish entry. And if we were to zoom out and look at it on the 5-minute time frame, it looks a bit different, where we have our high, low, lower high on increasing bull volume, and then follow through to the upside. So same scenario, where I would be drawing the high and the low of the most recent inside bar to be watching. That is the range of the daily candlestick that formed as the inside bar. And then as soon as we saw hours of follow through with big time momentum favoring those bulls.
So there are 5 things that we want to look at when evaluating any inside bar pattern. Think of this as a checklist for trading inside bars. 1, time frame matters. Now you notice earlier we went from a daily down to a 60-minute. Here we went from a 60-minute down to a 5-minute. Now for R-type trading and CFDs, we're going to daily is a good way to start looking for an opportunity. But we want to jump down to the 1 hour and then to the 5-minute because that's important to us. But first and foremost, the time frame you use to trade inside bars is extremely important. As a general rule, any time frame less than the daily should be avoided with this strategy. This is because the lower time frames are influenced by noise and therefore produce false signals. So we would want to start out with a daily chart and notice the first possibility. An inside bar that forms in a higher time frame has more weight simply because the pattern took more time to form. This means more traders were actively involved in its formation, which as a result equals higher capital flows. As you know, I'm a huge advocate of trading from the higher time frames, as they tend to cancel out most of the noise from scheduled and unscheduled news events. At a lower time frame, we're going to have many inside bars showing up. If you are trading a 15-minute chart on trading Forex, in one 24-hour session, you'll have 96 bars in your chart. Given that there are slower sessions of Forex, you have the potential to see too many inside bars that you may have to decide to trade. So remember, time matters. 2, trend. Now I emphasized this before. The bars, the mother bar should be coming off in the direction of the trend. Okay, so the age-old saying is the trend is your friend. If you have been trading for any length of time, I'm sure you have heard this one many times. As common as saying may be, it has never lost its significance in the financial markets, especially when it comes to trading inside bars. In fact, trading with the trend is the only way to trade an inside bar setup. Here are 2 examples of inside bar patterns that formed in different market conditions. The first example is what you look for, while the second is what you should avoid. Okay. So here we have our inside bar, mother bar, inside bar in a nice solid uptrend. Okay. So what would we be considering to look at? We'd only be considering this point at a buy scenario. So the bullish inside bar setup above to the right is formed on the USD JPY daily time frame. Note that this pair was in a strong uptrend leading to both setups. This is the kind of momentum you want to look at when trading this strategy. Now what you want to avoid is something like this when it's going into consolidation. When it's trading in a range and consolidation and sideways, you don't care about inside bars. You don't want to look for anything at that point. Then it's all about the breakout. What you're trying to do is once you've identified the mother bar and the inside bar, you need to see a break. The best inside bar setup forms just after the break in consolidation, where the preceding trend is set to resume. And the reason for this is quite simple. A period of consolidation within a broader trend is the market's way of regrouping. In an uptrend, the consolidation is triggered when the longs decide to begin taking profits. This causes the market to pull back, where new buyers step in and buy, which keeps the prices elevated. This pattern continues for days, weeks, or even months until new buyers are able to once again outweigh the sellers and drive the market higher. Here's an example of a great bullish inside bar that formed on the USD Canadian dollar. Now we can see we also have a beautiful triangle formation. We are coming in from an uptrend. We're moving into consolidation as we form the triangle, and the triangle tells you as we're moving to the apex, we're looking for that breakout. We get the inside bar, and the inside bar, we get the mother bar, which is the breakout of the triangle, and then we form the inside bar, and then we get the signal candle, okay, which then tells us that we're moving back into our break in consolidation and we're ready to look for a buy trade. So this is the ideal scenario for trading a bullish inside bar setup, as the market has gained a fresh set of buyers who are ready to push price higher. Now, of course, what's the key? What is the key? Volume. We always want to be looking at the volume. Now, a favorable risk to reward ratio is needed for any setup taking place on daily charts or hourly charts. This is true whether you're trading an inside bar, pin bar, or wedge breakout. Each and every strategy needs to be accompanied by a favorable risk to reward ratio. What's a risk to reward ratio? Well, it means always keeping your risk to no more than half the potential reward. So if you take profit of 200 pips, your stop loss can be no more than 100 pips away from your entry price. If using the more aggressive stop loss strategy, this means selecting inside bars that form near the top or the lower range of the mother bar. This allows you to achieve a much more favorable risk-reward ratio. But you would use the low of the mother bar or the high of the mother bar to set your range. So notice how the bullish inside bar in the illustration here shows the mother bar's range. This is what you want to see in a favorable setup, especially if you're using a more aggressive stop loss, which means placing your stop loss below the inside bar rather than the mother bar. So what most of us here should be doing is setting our stop loss here at the bottom of the mother bar and figuring out where our top should be, and then deciding whether our risk management allows us to make them. Now, the same holds true in a bearish setup. Now, size does matter. So, last but not least, the size of the inside bar relative to the mother bar is extremely important. Okay? So I'll say it again. The size of the inside bar, that's the baby bar compared to the mother bar, okay, is extremely important. This idea piggybacks off the number 4 above, where the inside bar forms in the upper or lower range of the mother bar. In my experience, the smaller the inside bar is relative to the mother bar, the greater your chances are of experiencing a profitable trade setup. Ideally, we want to see an inside bar form within the upper or the lower half of the mother bar. So in other words, where the baby is placed. Is the mother holding it up on a, up by her chest, or is it she pushing the stroller down by her knees? Remember that an inside bar represents consolidation after a large move. This is what makes the pattern so lucrative. The fact that we are trading a breakout after a period of consolidation. Therefore, the tighter the consolidation is, the more volatile the ensuing breakout will be. Of course, this isn't always the case, but in my experience, it holds true more often than not. And if you're following all the rules of watching volume, support and resistance, trend, you'll find that this happens quite often, giving you a good risk-reward ratio. What doesn't matter when trading this particular pattern is whether the inside bar itself is bullish or bearish. In other words, if a market is in an uptrend and an inside bar forms inside a large bullish candle, it doesn't matter if the inside bar is bullish or bearish. The same holds true when trading a bearish pattern. I always like to see my inside bar of the opposite color, but you can set your determination. It doesn't have to be. The only thing that matters is whether the mother bar is bullish or bearish. The formation of the mother bar in combination with the trend is what tells you which way the trade and inside bar setup. So keep this chart in mind. Remember, we are not really trading an inside bar strategy, but in this case, we are trading two strategies and using inside bars for our entry. So our first trade is actually a resistance holding trade. We are using the inside bar, the sign of lower volatility, and the position short in this context. This is a trade that sets up via mean reversion, a pullback trade. We are using the previous support now acting as potential resistance. You can short the break at lower levels. Keep in mind that the first trade is actually going against the trend that was occurring. It's against my better judgment, but sometimes we do. Price action leads us to consider a short trade, and we would know we were wrong if the price reverses and keeps moving upward. Profit targets would be the same regardless of your entry strategy. Our first trade could be a start to see if a new trend, so we would want to see how price reacts at the pivot before the final run up the price. Do you need a perfect inside bar? When the price action completes an inside candle on the chart, you should mark the high and the low of the inside bar consolidation range. Just, use your chart, draw a line across like you saw in our examples. Now, since we're only looking for high probability trades, what we're trying to do is filter out every trade that's iffy. So I always use very tight rules. Okay. So I always want to make sure my inside bar is fully formed and inside by every rule that I can adjust. I want to make sure it's perfect, because otherwise there's always another trade to be found. Just walk away from it. If it's not perfect, go find something else to trade, because there's always another trade be had. In simple terms, if price action interrupts the range upward, then you should go long. If the price action breaks the range downward, then you should trade to the short side. How do we enter trades with inside bars? So here's our chart again, our 1, 2, and 3. Rarely in trading is anything perfectly clean, especially if you take in consideration the mechanics of the market. Anybody that tries to tell you that price needs to react perfectly is confused, and most times close is close enough. Okay? Like I said, we need to make it a high probable trade. We want to filter it out. We don't want to break the rules, but our rules can't be so stringent that nothing ever fits. But to me, close is never close enough because I can always find a trade. There are too many variables in play to expect or demand perfection in price. You need to have perfection in your rules. You need to practice it and write your own set of rules so that you know and you always trade without making adjustments. Because what happens is then you try to force a trade. Do you need a perfect inside bar? I say always yes. The usage of a stop loss order is recommended for any Forex trading strategy. The inside bar trading system is no different. You should always put a stop loss when trading inside candles. But the question is always where. The proper location of your stop loss is slightly beyond the inside candle's top or bottom, depending on the direction of the break. In other words, if the inside range gets broken upward, you can buy the Forex pair and place the stop loss order right below the lower candle wick of the inside candle. The same is enforced for a bearish breakout just reversed. Projecting the potential move with an inside bar breakout can be challenging. And remember when we were looking at the setups and I said you had to figure your target, so you need to know where your target is in order to judge your risk reward ratios. So often inside bar trades can lead to a prolonged impulse move after the breakout. So employing a trailing stop after prices move in your favor is a smart trade management theory. But predicting how far it goes, you need to use other tools, especially support and resistance and volume. So along with this, I typically like to use a fixed take profit point of 1 to 1.5 to 1 or 2 to 1. Stay 2 to 1, okay, for us. In this matter, if the stop loss is 80 points from the entry, then a minimum target would be located at 120 pips distance. So let's take a closer look at inside bar pattern on chart. So here it's not complicated. We would see the inside bar pattern. We would set our stop loss below the low of the baby candle, or the inside candle. I like it, baby, you know right away which it is. You can set your high or your buy point after the break above the mother candle. Okay. So we would buy here after this candle had broken the mother price, the high of the mother. Okay. And this is where we would then expect it to go. So this is the H1 chart or the 1 hour chart of the Euro-US dollar. The blue circle on the price graph above to the right shows us the inside bar pattern, which we just looked at. We can see the highest high and the highest low. So there we can get our stop loss and our buy. The problem is the inside bar pattern does not give you your target. And that's what I said, you need to use other pieces of information. So conservative traders should consider buying the euro when the price action closes the next candle above the upper level of the range. Aggressive breakout traders would consider buying when the price reaches a few pips above the inside candle high. In either case, you should stop. Your stop should be located below the bottom of the range as shown on the image. So there's no doubt that inside bars can be a profitable way to trade the Forex market. However, if it isn't a setup that occurs often, at least not in a favorable context. This is why I don't advocate using inside bars as your only setup to trade. By doing so, you limit your trade potentials to this point that you are likely to begin taking subpar setups. It is therefore important to treat inside bars as just another tool inside your trading toolbox rather than the toolbox itself. The inside bar setup is capable of producing consistent profits, but only to traders who have the mind, keep in mind the 5 characteristics and practice, and write your own set of rules so you don't vary from them. So on that note, I'm going to say goodnight to you all. Thank you very much for joining us, and I hope you learned a little bit about inside bars, or baby bears and mother bars. So have a good night, and once again, thank you from Alvexo, and thank you from Investing.